precious metals got too frothy too fast, which led into a New York bloodbath. Everybody rushing for the exits at the same time. What Kevin Warsh's track record has been and what he might do as Fed chair could be two different histories. If he doesn't do what President Trump wants him to do, he won't be Fed chair for very long. And when we see these major sell-offs, they always tend to oversell. I've never seen the metals run this hot, this fast, whether it's inflation, tariff uncertainty, stability, the debt just keeps growing and growing and growing with no end in sight. All these things combined have helped to drive the metals prices. And I don't think this is over yet. I think this is a stop along the way. I don't think that $8,000 or $9,000 gold is unlikely in the next 5 years. I don't think that $200 silver is unlikely if we go that far out. And if we have another problem with supply, then these things will get turbocharged.
World War III is already happening.
This is a house of cards, and it is in the process of collapsing right now.
You're going to see an economic crash, the likes of which we've never seen.
Hi folks, Canadian Prepper here. Today on the channel, I was connected with Dana Samuelson, who we share a mutual acquaintance with, Peak Prosperity, Chris Martinson. Dana is the founder and president of American Gold Exchange with over 4 decades of experience in the precious metals industry. Today we're diving into the gold and silver market, what happened with the crash, and I'd like to hopefully pick his brain about the inner workings of the industry and what he's seeing on the supply demand side right now. I guess let's start off with I don't know what they're calling it. Is it Black Friday, Black Thursday? It was one for the record books, that's for sure. What is your perspective on what caused that major crash?
Well, we just simply, I think the precious metals got too frothy, too much, too fast. And this has been a very well-defined, driven market over the last year to 18 months, for both for gold and for silver. Leading into Thanksgiving and then December, we started to really move substantially higher faster, which is going to bring in the speculators. And when they pile in, get a lot of longs in the market on the futures exchange. When we get a real frothy top like we got last Thursday at 121 for silver and 56 and a quarter for gold. And then you see a crack in the market like we saw last Thursday when stocks sold off. It's not unusual for precious metals to sell off in sympathy to stocks when we get a little crack in the equities markets because of leverage traders, go to margin calls, they go to cash. We saw a bit of a crack then. We saw a rebound into the Asian market Friday would have been Friday night in Asia, Friday morning in Asia, early Friday our time. And the Asian markets actually started to sell off, which has been unusual because for the past week or so, it's been a bit of a tug of war where the Asian market would buy the market up and then the Western markets, London and New York, would sell it down and then back up, back down. Didn't quite get my hands right there, but to see the Asian market go into a profit-taking sell-off, which led into the London market, which led into a New York bloodbath, is really what happened. It was just massive selling, everybody rushing for the exits at the same time. And when we see these kind of major sell-offs, which we've seen many times over the years, it's just we've never started from such lofty levels before, with such universal attraction and froth. They always tend to oversell because there's a knee jerk, where sellers just keep multiplying. Becomes a vicious circle where more sellers beget more sellers, lower levels beget more selling. Silver bottomed at about $74 on Monday. We bottomed at about 71 yesterday, and now we're firming back up. Gold got as low as 4,400 yesterday, Tuesday, which I think was completely oversold. I see support for gold, 47 to 48.50, and we're over that now. And I see support for silver, at $80. I really think silver ought to be $90 to $95 the way the market is, and we're getting close to that. So we're bouncing, but anytime you get a market like this, where you get a downdraft, you get a bounce, you tend to bounce back down again a second time. So we may see some up and down movement for the next week or so till we really find firm support and resistance. But we're getting there, and it's settling down now that we've had a major correction, and we are seeing buyers coming back into the market now too.
And when you say buyers, is that buyers for the physical metal or for the paper?
Well, for both. Now we're physical dealers, right? So we gauge the markets two ways by what, I watch on the futures exchange pretty much all day, every day. I watch the contracts trade and the price change. But we also have physical business. We had a lot of physical buying come in with silver under $80 yesterday and the day before yesterday. A lot. So there's a lot of attraction. That's why I think there's a lot of support at silver, especially at $80 to $85 in that range. I think the world, this has been a physically driven market for the most part, which is why the corrections we've seen along the way have been pretty short and shallow. This has been a violent correction, but it may prove to be short. It may not be so shallow because it was big, with gold down 10% and silver down 30%, but it may be shorter than most people imagine because this has been a physically driven market that's been a globally driven physical market. Not so much in the US, which is unusual about this massive rally we've had in the metals. The last three times we've had similar rallies in the late 70s, during the great financial crisis and during COVID, we had a corresponding problem in the US, whether it was a geopolitical problem with hostages in Iran, an oil shock, a great financial meltdown, or an economic closure. We don't have problems in the US economically or geopolitically right now that would tend to buoy these kind of markets. So this has been absent a problem in the US, which is very unusual, which is why I call it a globally driven buying spree. And I think part of it is being driven by uncertainty around President Trump's tariffs on, tariffs off, and, not quite sure what he's going to do next. I mean, who expected him to pull Nicolas Maduro out of Venezuela a month ago, right? Yeah. That was a pretty big surprise. So I think there's a lot of uncertainty in the world. And there's also the bifurcation that we've gone through over the last 3 or 4 years, the global South against the Western nations, and a lot of demand for gold and silver, especially in China and India, two world's most populous nations.
Yeah, I mean, I think there's definitely some uncertainty because you see what's happening with the domestic civil unrest in the United States. While it's mostly benign at this point in time, it could definitely metastasize into something bigger. And geopolitically, I mean, there's potential for sparks everywhere. So I think it's not surprising that there is this kind of volatility and move towards safe haven assets. Obviously, this bull run was kicked off by a physical shortage. Would you agree with that assessment that initially this all started because of obviously fear in gold? People were concerned about the robustness of the USD and other geopolitical factors. But with silver, would you say that the jump off point was physical shortage? Do you subscribe to that view? And do you think that that is what's still driving the markets upwards, or is it more speculation at this point in time?
Well, there is some speculation, but we had the London Bullion Market Association literally break down in the silver market trade October 9th of last year. And that was kind of the emperor has no clothes moment for the silver market, right?
Can you do me a favor and explain how that system works to my audience? Because you're speaking to a preparedness audience, which is not always, well versed in how these metals exchanges actually work.
All right, so let me give you the setup. It'll take just a couple of minutes. So first of all, last year was a transition year with President Trump coming into office. The tariffs that he's been deploying, which have been much more dynamic, larger than most people expected, caused two massive runs into metals last year. Last April, while we introduced the reciprocal tariffs on every other nation, and then were forced to pull them back a week later on April 9th because of all the bond problems we had in the U.S. We had a bond sell-off in the U.S. market, and bond yields spiked. It was a meltdown in the U.S. bond market. It took a week. That's what caused President Trump to pull the reciprocal tariffs back, but China stood toe-to-toe with us. So what did we do? We ratcheted tariffs up on China to 145%, while we pulled them back on everyone else, because China literally stood up against us and said, okay, we'll tariff you. And by the time we were done, we were up to 145% on them. That caused the Chinese to go into a massive gold buying spree. Because if you're a Chinese businessman and your best customer is suddenly basically saying, we don't want your products, and we're 20% of their market share, what do? Well, they can invest in stocks, they can invest in real estate, both of which have done poorly since COVID, or they can invest in precious metals. And they went on a buying spree buying gold that helped drive gold from about $29.50 to $34.50 in about 2 weeks. That's the first episode we saw of physical buying. The second tariff-driven physical episode we saw started basically August 28th, when President Trump ramped tariffs on India up 50% because they continued to buy Russian oil. And this is about the same time Jerome Powell said that we would go into an easing cycle. So a lot of people missed the Indian 50% tariffs. But when that happened, India went on a massive, primarily silver buying spree because gold had become so expensive already. Gold was already over $4,000 an ounce, and silver was under 50. And India drove the silver price sharply higher, creating a lot of physical demand for silver. Now, concurrent to that, we had a lot of metal move into the U.S. COMEX exchange warehouses last year over fears of potential tariffs on gold and silver. Now, normally we have about 20 million ounces of gold in the COMEX warehouses, 11 different banks that hold silver and gold. 20 million ounces turned into 45 million ounces of gold in COMEX warehouses last April. 200 million ounces of silver turned into 531 million ounces of silver in the COMEX last October. So we took in more than double what we normally hold. That took metal off of the rest of the world's exchanges, primarily out of London. And then when India went on that buying spree in September into October, including ETFs in India, which are buying physical silver, they wiped the London Bullion Market Association of silver, available silver, out. Normally there'd be more of a cushion there, but a lot of that silver ended up in New York. So we've got more silver than we need in New York and not enough in London. And what happened when that demand wave hit, there just wasn't enough silver to cover the orders in London. Lease rates spiked. Delivery times got pushed way back, because London is basically a vaulting warehouse for most of the world precious metals. Central banks hold gold in large quantities, but there's not the same central bank holdings of silver. So the cushion in the silver market is less. It's a much tighter supply chain. And we literally wiped it out of available silver at the time because of this dynamic that occurred where too much metal moved into the New York warehouses, primarily out of London, and then a demand wave hit. They couldn't absorb the amount of silver that wanted to be bought. And that created a physical shortage. Now we're seeing some of that come back out. We've seen almost 100 million ounces now go out of the COMEX exchange warehouses in the last 3 months to help satisfy demand that's elsewhere. But we're seeing a shift, a sea change also that's happening that is we've never seen before, which is dynamic and powerful, which is industry and governments are now trying to secure supply lines for silver in ways that they never have before. A year and a half ago, Samsung announced that they had come up with a battery for electric vehicles that's silver-based. Takes about a kilo of silver per battery, the 32 ounces, if I have my ounce count right for the batteries. Charges in 9 minutes and can go 600 miles on a charge. This is a big deal for electric vehicle owners, because most people, they can't go 200 or 300 miles without needing a charge. It takes 30 minutes. This is double the range and less than half the time to charge. So they're going to need silver if these batteries work. Well, they are investing $175 million now directly into a closed mine in Mexico, the La Paria mine, to secure a supply source. And we've also seen Chinese government try to buy into 2 Canadian mines in the last 2 months, buying silver right out of the ground to secure supply lines and offering a premium over the spot price of $8 or $9 per ounce to secure this. Now, I don't know if the deals have been made or not. I don't think they have, but they're trying to do that. Now,
and they're willing to pay that premium because the silver doesn't exist, like right now.
Well, they want to make sure that they have enough silver for industry. What does China produce that needs a lot of silver? And they're leaders in
solar
power. Yeah, excuse me, senior moment.
Yep. That's all right.
Yeah, so they're leaders in solar energy, and they need a lot of silver for those solar panels. It's a big part of their industrial exports and their business model.
But what I'm saying is, if they're willing to pay $8 or $9 over spot, it must be because there's some pretty serious scarcity in the supply that they're willing to not only pay over spot, but to dig it up themselves.
Right. They're concerned about future supplies, and they're trying to lock those down. That's what this is all about. And we've seen China go into Africa for the last 15 years on the Belt and Road Initiative, developing the infrastructure to harvest natural resources in Africa, putting in roads, putting in ports, helping to build mines, loaning a lot of money into poor African countries to develop these resources. And if they can't pay the money back, well, then China owns the assets. And that's what's been happening. Now, the U.S. doesn't do that kind of critical mineral resource securing, which is what China's been doing for years. Now we're trying to play catch up. What did President Trump announce yesterday? A $12 billion, critical minerals fund, right? This is the U.S. now trying to make sure that we have enough of the things that we need to make industry run, because we're dependent upon China for a lot of what we need. China has 93% of the world's rare earth mineral processing capacity. Now, rare earth minerals really aren't rare, but the ability to turn them into what we need them into for use is rare, and they control that processing. It's a dirty, dirty business, ecologically very unfriendly, and we haven't wanted that on our shores for those reasons, but now we're going to be forced to duplicate in the U.S. or elsewhere what China has been doing for 10 years now, building the capacity to process these kind of things. So this is going from kind of a covert land grab for not just gold and silver, but other critical minerals, into an overt one this year, where we're now saying, okay, we're going to try and grab what we can get to secure these resources. And this is particularly acute with silver right now. That's why I think there's a pretty big floor under the silver price that the world is going to put under it. I don't think they're going to let silver get too cheap. And I think the prospects for silver to move higher in value into the $120 to $150 range are still very likely, despite the recent correction we've just gone through. Nothing's fundamentally changed. It's just we've seen speculators pile into the market and now pile out to lock in profits, monetize profits. And this is a typical pattern, but it's just been a big, big move because we started from $120 an ounce instead of $35 an ounce, where it's, we would have started out for most of my 40-year career or less, right? So that's the explanation.
Do you think that the deal that was struck yesterday with India then is going to cause them to relent in their acquisition of silver for monetary purposes?
Potentially. One of the problems is the Indian rupee. They have inflation in India that's higher than most other nations. One of the websites I like to look at is called goldprices.org, which shows price appreciation in every major currency going back 15 years for both gold and silver. And over the last 2 years, the country that's had the highest appreciation in precious metals values has been India, because the rupee has lost more value to other currencies in purchasing power and to precious metals because of inflation in India. And that has been a big driver of gold and silver buying in India over the last 2 years. But what's also happened this year, and this may help to mitigate this reduction in tariffs, is that Indian consumers, up until this April, in another 2 months, could only use gold as collateral to borrow money in banks. But last fall, they passed a law that said as of this April, 2 months from now, they'll be able to use silver as collateral against bank loans. And that's helped to fuel demand for silver in India as well. Because a lot of Indians can't afford an ounce of gold, but they can afford 5 ounces of silver or 10 ounces of silver. And if your currency's losing value and you have a precious metals culture, that helps to fuel it as well. So, yeah, the fear and uncertainty over 50% tariffs being dropped to 15% or 18%, I'm not quite sure where they're going to drop to, but substantially lower, could mitigate that a bit and could mitigate some of the inflation in India, which might tame demand down a bit. But it's not just India and China, it's the whole world has been buying precious metals. And I've called it kind of a run on the bank, actually.
Contrary to popular belief, in the apocalypse, most people aren't going to die by the hands of marauders. In fact, you're probably going to die from disease. This is why you need antibiotics. The problem is, getting them requires a prescription. Well, today's sponsor is Jace Medical. They've created a revolutionary service that allows you to get prescription medications like antibiotics with relative ease, hassle-free. This will be worth more than gold in an emergency for somebody who needs them. So do yourself a favor and take your prepping to the next level while you still can. Check out the link in the description below. And now, back to the video.
At what point does it become not economically viable to use silver in industry? I mean, we hear these sky-high valuations of 300, 500 by some people in the space, but are solar power companies willing then to take that hit on their margins, or is the market going to potentially respond negatively to that? Will there be some demand destruction, I guess it would be, if we start seeing silver get too hot? Then a lot of these, photovoltaics, batteries, using it in satellites, data centers, all these things become unsustainable.
It's how much can the market bear? There certainly will be some market destruction, demand destruction because of higher values. But in some instances, there really isn't a good alternative, especially for silver, because silver is one of the most conductive metals there is. I can take an ounce of silver, hold it between my fingers, and hold an ice cube in my hand and literally cut through that ice cube in about 5 or 6 seconds, just because the temperature from my fingers transmits into the silver and goes through that ice cube. That's how conductive silver is for temperature and also for electric current. The second best alternative is copper, which has a lot lower value. Now, there's going to be some trade-offs, but we've also seen copper prices hit record highs recently. Now, they sold off on Friday and Monday as well, but they're rebounding a bit now. So it's not just gold and silver, it's other metals as well are involved in this that are necessary. But there will be some substitutions where applicable. Now, my iPhone has $20, $30, $40 worth of silver in it. If that goes to 100 and the iPhone costs $1,500, is the extra $50 going to matter that much if silver goes from $100 to $200? In some instances, it won't matter that much. In others, it'll matter a lot, and there will be some demand destruction as a result of it. But the problem we see is that most of the industry that we need these metals from has been underinvesting for years. So when there's a ramp up in demand, there isn't a concurrent ramp up in available supply that's easy to occur without significant financial investment by the mining companies. And silver is primarily a byproduct of mining of other metals. It's not a primary mined metal. So we just can't print a lot more silver easily like you can print currency, or like you can pull gold out of some vaults, because there's a lot of gold lying around in vaults that central banks have held for decades.
In terms of the current situation with supply and demand, I know it's kind of like asking a barber if I need a haircut, and I don't have any hair. But you're a gold exchange broker, and so you buy and sell metals. What are you seeing on that side? Can you give us your honest assessment of what the market looks like right now? Like, are more people buying? Because you always hear conflicting reports of more people are selling, more people are buying. I've heard that the whales are buying and the governments are buying, but the little mom and pop are kind of selling because they've had these trinkets laying around their house for many decades, and somebody told them it was worth 10x now, so they're trying to pay down their debts. What are you seeing with that respect in your industry?
All right, so let me give you the bigger picture setup first. As I mentioned earlier, we haven't really had a problem in the U.S. in this cycle, while prices have been rising so sharply. There's no fear in the U.S. markets. So as gold has moved from 3,000 to 3,500 to 4,000 to 4,400, 4,200, we've had a lot of sellers of gold in the U.S. And the same thing with silver. When silver got over $40 an ounce and moved all the way to $90 or $75 an ounce, we didn't have many buyers here in the U.S. market because of a lack of fear. We had a lot of sellers. So we have had more supply than demand. Now, when gold got over about $4,200, $4,300 an ounce and silver broke 60, 65, we started to see some buyers step into the market, usually bigger players who understood the dynamics, that this was a real breakout market, not just a fluke. There has been a lot of investors that have bought gold and silver a lot cheaper, that have had them for years, that have never taken profits or used that money for other things. And we've had inflation's bite has been significant. So that's what helped to contribute to selling. But now that has rolled over, and we've had a lot of buying come in as the fear of missing out on this rally has really caused some buying to occur. But that's mostly gold over 4,200, 4,300 an ounce, and silver over 60, $65 an ounce. In the last couple of weeks, as silver in particular broke 100 and got up to 120, we had a lot of people say, "Oh, I got to sell. I've had this forever. I'm making a double or a triple now, and I've got to sell some." So buying really ramped up going into last Friday, and then it's dried up for a day or two, and now it's kicking back in at these lower levels. Like I said, we sold a lot of silver yesterday on the dips that we've seen, but we haven't got kind of that froth of both buying and selling that we had just a week and a half ago. Things have settled down a bit as people are reacting to the price change and trying to decide what's coming next. And I do think we've oversold a bit. We should firm up a bit, but it's going to be a bit bouncy along the way.
And what are you seeing in the industry itself in terms of the refinement process? I know there are various bottlenecks in terms of melting things down into bigger Boolean bars, or maybe down into more numismatic stuff. What is the industry looking at in terms of those choke points?
Well, not so much for gold. The gold market's remained pretty normal as far as physical buying and selling, available supply. But because silver has hit such high prices so quickly, the buyer of last resort to recapitalize dealers like myself or bigger dealers, and a lot of smaller dealers, are the refineries. And they've been the bottleneck or the choke point primarily for silver since last October. We've started to see problems ramp up where refinery backlogs are causing delays in settlement. So if a dealer like me buys 5,000 ounces in or 10,000 ounces in, and we need to get our cash back, we can't resell it to the other public or other dealers because they're full. We sell it to refineries. Normally we get paid in a couple days. Now they're stretching those payments out 2, 3, 4 weeks, tying up cash flow that we need to continue to operate. That's how the bottleneck works. It's become much more acute for non-pure silver items like junk 90% silver coins, the old dimes, quarters, and half dollars. Canada, you've got 80% silver coins, right? You got to take that other 20% or that other 10% out. A lot of refineries just quit buying the less than pure because it's more time and effort and they've got enough to handle already. And what they're primarily doing is taking either the 1 ounce coins or the rounds and bars, 10 ounce, 100 ounce, and turning them into 1,000 ounce bars,
Right.
which goes then into the exchanges or into ETFs. That's really a friend of mine said a couple of months ago, there's plenty of silver in the world. It's just in the wrong place, in the wrong form. And now a lot of that's going through the refineries to be processed into what the markets really want more, which are 1,000 ounce bars. But we've also seen a problem with demand ramping up in the US with a lot of customers who want sovereign minted 1 ounce silver coins, which are now hard to get our hands on because the mints can't keep up with the demand that's occurred with these higher silver prices. They were converting from 2025 dates to 2026 dates when demand really started to ramp up. So there was a hiccup in the supply chain starting October, November into December. And now they're not keeping pace with demand. So we're in delays to get products that the mints are producing, but they've got to catch up on the backlog of what's been already ordered. So we're in a delayed delivery situation for US Silver Eagles, Canadian Silver Maple Leafs, to a degree, Austrian Silver Philharmonics, and slightly higher to more than slightly higher premiums over spot for these same products, just because there's not enough to go around. We've been in these silver squeezes in the past, primarily during the great financial crisis and during COVID. What we're in now is not nearly as acute as we've seen in the past, but the mints just haven't been able to keep up. They're starting to, this will help them, this correction will help them catch up a bit because it's going to slow demand down a bit. And they do want to sell out.
There was an initial, like you're saying, initial supply shortage on the industrial side, and maybe that's starting to catch up, but now it's more on the minting side for the smaller.
Yeah. So, for example, the U.S. Mint decided to stop making 2025 Silver Eagles in October. They normally keep making them into December, and that's right when the supplies, demand started to ramp up. So they were ahead of the game, and they technically cannot release anything dated 2026 until this calendar year, where the Canadian Mint will change over in 2025 in October or November and start releasing 2026 dated coins, almost immediately thereafter. But compounding this has been fear of tariffs. No one's been really sure whether silver was going to get tariffed or not. And you don't want to have a shipment of silver from Canada or Austria or Great Britain in the pipeline when tariffs are put on. And then suddenly, when it gets to the border, now it's going to cost whatever that metal price is, plus the premium, plus the tariff, because you may not be able to sell it with the higher tariff cost added on. And that's put hiccups in the supply chain, primarily from exterior products to the U.S. as well. We think we have clarification on that now, but you're never quite sure with the Trump administration.
Is there a lot of reluctance too on people in terms of bringing in supply, not knowing what the price is going to be from day to day? Is this volatility impacting a mint's desire to maybe purchase large amounts of raw silver because they don't know if they're going to be able to sell it? Does the market kind of have to settle a little bit before people are willing to commit?
Well, the mints are used to market volatility. They're not used to these prices or the kind of volatility that we've just gone through. I mean, that's not their primary business model, but their model is to sell, right? They need to, that's how they earn their profits. That's how they stay in business. The Canadian Mint in particularly strikes a lot of collector coins for a lot of other countries and private individuals. So they have a business model that allows them to profit above and beyond their precious metals minting, which other mints do not have that luxury, right? So that helps to supplement and to support the primary business of making bullion coins. Now, if mints can't secure supplies or do it at a reasonable price, and this is their primary business model, well, they'll just stop producing product for a while until things settle down. That's just, they're not going to have a choice. They're not going to have an alternative. We haven't seen that yet. And I don't know if we will at this point in time, but it's certainly caused a lot of issues in the dealer community because we've been overrun with sellers at points in time. We've got this price volatility. We've got backlogs at the refineries. So we're getting a wider buy-sell spread to compensate for some of these big fluctuations in the market. Quotes on spot silver, which would normally be, 20 cents, 30 cents, 50 cents between the bid and the offer, have gone to $1 or $2. Bid 88, sell at 98, 88, sell at 90 spot, right? So if you're selling to me, I'm going to pay you spot basis 88. If you want to buy from me, I'm going to sell you spot basis 90. I mean, some dealers the other day were quoting $5, $7, $10 spread on spot to accommodate for the volatility. Now, we didn't do that, but I mean, that's how you compensate for some of this if you're running a day-to-day business. And, we also hedge in the futures market to mitigate price volatility. But when you're doing frenzied business, it's hard to make a perfect, hedge against your inventory as it's coming and going so fast, and including when there's market volatility.
So last week, these metals were running really hot. A lot of people were starting to get concerned that maybe something in the system was breaking or was about to break. And then we suddenly had 4 pieces of news that just kind of came out of nowhere, it seemed. One of the pieces of news, of course, was the Fed chair stuff, the change to Kevin Warsh, which the markets presume is going to be more hawkish, but the jury's still out on that. Then this Monday, we had the Indian tariff thing, and we also had the Epstein files release, which has kept people busy for the last 3 days, looking for clues down that rabbit hole. And then we also had this kind of pause in the Iran war drums beating. Do you think, despite what Powell said, that, wow, we don't really care about the price of gold, is somebody panicking and trying to hit some circuit breakers of sorts in order to stop this rally? Is there something more than just the futures market and options trading that is the cause of this major bloodbath that we've seen on Friday?
Well, I think your comments about Kevin Warsh are applicable. That was part of what was attributed to the Friday bloodbath, was that Warsh would be a hawk. And one of my friends used the headline, we had a precious metals Warsh out, which I thought was kind of appropriate. But what Kevin Warsh's track record has been, and what he might do as Fed chair under Donald Trump, could be 2 different histories.
Yeah.
If he doesn't do what President Trump wants him to do, he won't be Fed chair for very long, one way or the other. So I suppose that he will probably blow with the prevailing wind once he becomes Fed chair. And I think he will become Fed chair. I think that's going to be pretty easy for him to be nominated and put into that position. Number one, the Epstein files.
It seemed like he did, it was very timely. Like, I mean, it seemed like there was very little resistance at the top, and suddenly they make that announcement. But Peter Schiff was saying that he had a pretty high chance of winning. So it was like 30 to 40%. So the market kind of knew that he might win. So it seems like a really aggressive pullback just to be attributed to that, when the markets kind of suspected that he would win.
Yeah, I think, when you get a big sell-off, especially after a big run like this, what trips it could be something more psychological than actually meaningful. And I think that's part of what it was. It just, selling begat more selling, especially when we've got a lot of speculative positions built in. Because what the speculators do is they take a position, and if the market runs higher, they'll pyramid on top of that. And now they've got equity in that base position, so they can add to the new positions on without having to put more money in, right? Mm-hmm. And they can keep pyramiding up. So they get a big position in place. And then if the market turns, they've got to dump the whole thing at the same time, right, to protect profits. But what's also happened is the COMEX exchange has raised margins again. right? They raised margins 4 times in December, which helped to break the rally that we had following Christmas. They went from, in silver in particular, from a fixed dollar amount to a percentage from 9%, and then they moved that up to 11% of the contract value. And now they've raised it as of a day ago to 15%, which means to hold those same positions, you've got to put more cash in to hold those contracts, or you can sell some of the contracts to use some of that money to capitalize the margin requirement for a lower position. I think that helped to put metals into an oversold condition yesterday, where gold got to 4,400 yesterday and silver got to about 70. And where are we now? Silver's, close to 88, 89 today, and gold is over 4,900 today, last I looked. Yeah, and they're holding most of those gains right now. So, it's a lot of it has to do with the COMEX exchange, and their changes in policy to accommodate for volatility in the markets and higher values, because they've got to have a cushion between them as a intermediary between buyers and sellers, so the exchange doesn't take trading participant losses. Now, with regard to the Epstein files, I don't think that has much to do with the precious metals markets, and I discount that. With regard to lessening of tension between the U.S. and Iran, that could help take a little steam out of the market, because, when you send a fleet of war vessels over that way, and I've been expecting, this is my own conjecture, personal conjecture, that we might take a headshot at the Ayatollah Khomeini.
Oh, we absolutely will.
Right? I think that'll be the first salvo if there is physical violence between the U.S. and Iran in a direct conflict. But what's happened over there with those protesters has been amazing. And, there's been talk of, thousands and tens of thousands of people being killed by the regime, which is what President Trump wants to stop, of course.
There's a big debate about those numbers, but
right.
There's definitely tension building, and it seems inevitable that they're going to do some kind of strike. It seems like they're just moving their assets into position and engaging in the same sort of deceptive tactics to kind of bring them to the negotiating table, only to perfidiously stab them in the back again.
Well, after seeing what happened with Maduro in Venezuela, I would be concerned if I was the Ayatollah Khomeini and I saw those ships coming my way. But, there's a lot of posturing, and how it's perceived is going to have influences in the market, right? So, and that's typical in these markets. We get these psychological events that drive them, as well as sentiment changes, war on, war off. Who knows what's actually going to happen? Look at what Putin has done in the Ukraine. He's talked a nice game about playing nice while he's continued to pound the Ukraine mercilessly, for this whole past 2 years, while he's, at the negotiating table talking about what might happen. And, 1 week we think that, that's going to get settled. Then we realize, it's going to go on a while longer, and then it's going to get settled again. It seems we'll see how it all translates.
It seems like that's about to flare up again, because there was a bit of a détente in terms of on the critical infrastructure, but that's resumed now. They're starting to attack power stations inside Ukraine once again. So it appears as though that's flaring up, although Trump said some positive things yesterday with respect to what the outcome might be of these ongoing negotiations. It still seems like there's a lot of tension in the air. And so people will continue to gravitate towards these safe haven type assets. So what exactly do you do at American Gold Exchange? And just so people know, we have no affiliation or marketing arrangement or anything like that. Bring on a wide variety of gold and silver talking heads in order to tap their brains about, what they're seeing in the market. And then I bring on some people who are a bit more contrarian and take the opposing view. But what do you do for people that is different than other gold exchanges?
So we're physical dealers. We buy and sell. We make a market to the public between the trade and the public. So we deal with mint distributors, refiners to secure product that we in turn sell to the public. We're also vintage U.S. rare gold and silver coin experts. I've been in the business for 45 years. My mentor was James U. Blanchard III, who helped to re-legalize private ownership of gold in 1974. I worked for Jim for 10 years, and now I learned the trade.
So are you the guy that Pawn Stars calls up to see if something has value?
No, I don't know the Pawn Star guys myself, but I've got a couple of friends in the industry who know them very, very well. So I've been going to vintage U.S. gold coin shows for 45 years as a buyer and a seller of vintage gold coin products with other rare coin dealers in the U.S. But we're also bullion dealers. So we make two different markets, in the vintage coins and in the precious metals markets. And, I started American Gold Exchange in 1998 when gold was $300 an ounce and silver was $5 an ounce, close to the bottom, because I wanted to be in business for myself. So I've just leveraged my contacts in the industry. Several of my friends run U.S. Mint distributorships. Which are the biggest physical dealers in the U.S. And, I've been personal friends with some of these people for 30, 40 years. So my connections go deep. And we just make a very competitive buy-sell market to the public in the most widely traded, competitively priced precious metals products, primarily sovereign minted 1 ounce gold and silver coins from the U.S., Canada, Great Britain, Austria, Perth Australian Mint, the refineries in Switzerland and Japan, and the vintage U.S. gold coins. We're consultative in nature. We try and help people in the space. We are an unregulated industry. Anybody can be a precious metals dealer tomorrow, and we have opportunists that come into our space who take advantage of people in good markets, and we've got some in place now. And we also have dealers that are just unscrupulous, that are just trying to take advantage of the public where they can. And my business is taking good care of our clients because that's our main asset. We have great referral business, great repeat business, and great reviews. If you look at our Trustpilot review, it's 4.9 or 5.0 stars, which is incredibly hard to attain because we just say what we do and we do what we say very, very competitively to make a fair market to people. That's what our business is.
So you probably stacked enough silver and you got your bug out bag down packed. But this is going to be real currency when it hits the fan. Freeze-dried food that lasts 25 years, retains all the nutrients, all the texture, and all the taste as it did the day it was sealed. This is basically post-collapse money. And Wholesale Freeze Dryers is hands down the best company in the business. Go check out the link in the description to get 15% off hundreds of different varieties and build up your own post-collapse preparedness pantry.
I know you come referred by Chris Martenson, who I respect a lot. So, that's saying a lot for me. What do you say of the criticism? And I ask this to a lot of my, people I have on who do work with gold exchanges. People will say things like, well, if gold is going to increase in value so much, why are you selling it? Why aren't you not keeping it for yourself? What would you say to that sort of criticism? Because there is some people, like I've had Peter Schiff on, I can't remember how many times. I love the guy. But it seems like it doesn't matter how high the price goes, it's just going to keep going higher and higher and higher. And there's never like this, pause for caution or anything.
Well, our business is to make a margin. We earn a profit, a spread between what we pay for metal and what we sell the same metal for. And on gold, the buy-sell spread to the public is about 4%. On silver, it's a couple dollars an ounce. The trade itself trades inside that spread. The dealer-to-dealer spread's about 2% on gold, where it's about 4% to the public. And on silver, it's $1.50 to $2 an ounce, where to the public it could be $3 or $4 an ounce. So we trade the spread. That's what we do. That's our market. We have inventory, but we also broker.
So you make sure that people are getting real metal from a trusted source. And so that's your kind of intermediary service.
Yeah. Plus, I've got deep credentials in the marketplace. I'm a past president of the Professional Numismatists Guild, which is the leading organization of rare coin dealers in the United States. I was president in 2016 and 2017 when it came to our attention that the Chinese were counterfeiting a lot of precious metals products and bringing them into the marketplace, primarily through online auction platforms and private sales. I helped to establish I conceived of and helped to establish the Industry Anti-Counterfeiting Task Force that today works with Homeland Security and Secret Service to interdict shipments of spurious precious metals products coming in from out of the country to protect the integrity of the product in the marketplace. That's something I didn't have to do, but I recognize it as a need. And I said, we can't do this as an industry by ourselves. We need to have other mints involved. We need to have this Homeland Security, Secret Service, and we got it done to protect the product. Now, we had, Gucci call us, the Coin Dealers Association, going, how did you do it? The Chinese have been knocking off our bags for 3 decades, and we couldn't get the attention of the U.S. government. Well, when you're counterfeiting U.S. mint products, that helps to give you an advantage. But that's part of what our responsibility is, to make sure the product we handle is real and verifiable, and we'll buy it back, right?
How does the collectibles market respond to these crazy changes in price? Is it impacted that much? Because I know you're paying a pretty significant premium over spot price for some of those products. How does the current market volatility impact those prices?
Well, the gold price going from $2,000 to $5,000 an ounce has impacted the vintage U.S. gold coin market substantially, because collectors have not followed through with buying at these higher prices. So we've seen premiums for what are pretty scarce coins, come way down, if not collapse entirely, due to the higher metal prices, because you have more sellers than buyers. And the market, is made of, 300 or 400 dealers around the country who can become undercapitalized and over inventoried very quickly in a situation where you have just more sellers than buyers. Now, the rare coin market, a coin where there's one of 20 that might be, $100,000 coin, that's much less impacted than a $20 gold piece where we know there's 500,000 of them that are pretty scarce overall compared to bullion items. So they're going to be, 1 million made this year, 1 million more next year. But still, if the public doesn't want them to pay 20% over melt for them, when they can buy an ounce for 4% or 5%, and that's going to impact the collectible premium of those coins, and it has. So we're selling, vintage U.S. gold coins at some of the lowest premiums we've ever traded in my history right now as a result of what's happened. How that settles out over time will be anybody's guess, whether we'll see some of that premium re-expansion or not. But these are really, really scarce coins overall that just people don't seem to want right now, in favor of just simple ounces.
Yeah, a lot of my audience is more interested in the, getting stuff at spot and just bullion as opposed to the collectible aspect of things. But just one last question for you. You've had an extensive career in this industry. Have you ever seen a period of time that has been this crazy in the precious metals market? And how does it compare to maybe what we've seen back in 2008 to 2012 or in other run-ups throughout history, I guess, in the 80s?
Well, I got my start in 1980. So I caught the tail end of the big boom, but I didn't understand the perspective of it. To me, it was, this is just how this market works. And then I went through 25 years of gold between $300 and $400 an ounce, silver cheap. Yeah. The frenzy that we saw during the great financial crisis and during COVID was because there was a lot of fear in the U.S. market. We had a lot of the public that had never bought gold during the great financial crisis learn how to trade it. A lot of people that learned did it all at the same time when COVID hit. So that was an explosive demand wave. But as I said, there hasn't been fear in the market in the U.S. during this cycle. And to see the metals prices run so much higher, absent a concurrent U.S. economic or geopolitical issue, it's incredibly rare. And I've never seen the metals run this hot, this fast anyway. So yeah, it's been a game changer, and I really liken it to just a global run on the bank of gold and silver over the last year for a host of reasons, whether it's inflation, tariff uncertainty, stability, global bifurcation that continues to happen because of the West sanctioning Russia, throwing off the SWIFT banking system and weaponizing the dollar. Now they're calling it the debasement trade. And the debt just keeps growing and growing and growing with no end in sight. The paper money experiment that we've been going through since 1971, when the U.S. was no longer backing the dollar by gold, and the global debt explosion, and now the debt trap that we're in, where we might have to print money just to pay the interest on the debt in the U.S. We've been worried about the debt growing for 20 years. It seems like the whole world started to worry about it last year for the first time as we've hit these lofty levels. So all these things combined have helped to drive the metals prices to record highs we've never would have even imagined 2 years ago. And I don't think this is over yet. I think this is a stop along the way, this correction that we're in. Now, we may not see the kind of acceleration in price that we saw last year, which was extraordinary. When you get a year when gold goes up 75% and silver goes up 200% in a year, that's extraordinary. And no, we've never seen anything like it before. But I don't think the reasons for all these runs to be over have changed. We're hitting a pause in the markets right now.
With respect to the looming debt crisis, that seems like it would yield accelerating returns if it was purely a debasement style trade. Do you think this is just the beginning of something possible? Like, where do you see this in 5 years if that debt situation can't be resolved?
Well, I don't like to look too far over the horizon. I try to be a realist because what I say I want to have credibility, right? 5 years out is a pretty long way. Now, Peter Schiff is good at that, and I'm friends with Peter. I know him pretty well. I don't think that $8,000 or $9,000 gold is unlikely in the next 5 years. I don't think that $200 silver is unlikely if we go that far out. I think my sights are more realistically set on gold at $6,000 an ounce in the next year or two, and silver at $125 to $140 an ounce in the next year or two. I think those are entirely doable. But you never know what'll happen. If the U.S. can reshore industry, we can get a manufacturing base, we can get our economy humming, we can settle these geopolitical conflicts and start to bring our debt under control, well, that'll arrest these precious metals runs that we've seen. But that's a tall order and a lot of changes that may or may not happen. And I don't see them happening right now. Some of that could occur, but not all of it. And I think we'll continue to accumulate debt in the meantime. And debt has been the fundamental driver until this past year. Now, most of the things that normally impact metals prices, the metals market separated from in the last 3-4 months. Inverse correlation to the dollar, to yields. I mean, we just went on a run on their own sake. These are small markets, so they can get bullied. You hear a lot of talk about manipulation. To me, it's just, the big players can stomp around and bully a bit. But they said gold was manipulated down at $300 an ounce in 2000, 2001. And I watched them manipulate it all the way up to $1,900 in 2011, right? And now we've got $5,000 gold. So the markets are going to go where they're going to go in the long run. They get pushed around a little bit in the short run. That happens. And that's just nature of the beast, right? But I do think we're going to see continued price appreciation. And it's normal for gold to appreciate 5, 7, 8% a year, and silver to do about the same just on debt fundamentals, inflation alone, let alone a lot of these other things. But this has really been a run on the physical markets. And if we have another problem with supply or a breakdown in the COMEX exchange where contracts that are supposed to be delivered don't get delivered, then these things will get turbocharged, right? Because that's another episode of The Emperor Has No Clothes. That's a possibility.
There's a lot of FUD circulating in the last couple days trying to scare people out of the markets, it seems. One of the things that you hear lots about is, good luck selling your silver or gold. Can you shed some light on that process for people? Because I'm pretty sure it's not as easy as pushing a button on a screen, but I personally know here in Canada, there are many options that are very reasonable and pretty expedient. Is this a problem for people, or has this been overblown?
It has become a sticky issue because of capitalization, right? Now, if you're a dealer like me and you're working from prices 2 years ago to now, we've got to have more than double the cash to hold the same inventory, right? Because the prices for metals have doubled in the last 2 years, gold and silver both. So now for me to keep the same inventory, I've got to have double the amount of cash. And we get into cash flow tightness at times, right? So we can only buy so much without selling something to keep everything turning. And that's where most smaller dealers run into trouble. They can buy faster than they can resell or get paid. Like I told you how the refineries backlog dealers by a month or two in their cash flow. That's a real problem, right? And that creates discounts on the buy that become excessive. Like right now, the bid on, unpure silver is drastically lower than pure silver because we can't send it to the refineries and get paid quickly if we have to. And most people don't want 90% silver, sterling silver flatware, or 80% Canadian. So there are issues. That's why having a relationship with a dealer is important, because in a situation where our capacity becomes full in buying, and we have our clients that want to sell to us, or people we've never done business with us that just want to take profits, we have to take care of our clients first. We have a responsibility to the people that bought from us, that have helped support us on the way. And we try and make a fair market to everybody, but if we're forced to make a choice, we're going to go with our own clients first out of a fiduciary responsibility. Or, we're going to have a discount that is larger than we'd normally want to have to give ourselves enough cushion in a volatile market. These are some of the things that every dealer runs into at some point in time. And we're seeing it happen with some of the biggest dealers in the world in the last couple of weeks because of so much selling into the market for some items and too much buying from the market of other items, right? So we have delivery delays on the 1 ounce products, but discounts on 100-ounce bars actually tumbled last week when so many of them came into the marketplace, and some of the biggest dealers in the world had no place to go with them. So it's a very fluid, dynamic market environment, and things can change on a daily basis as equilibrium between buying and selling, cash flow, and volatility of market pricing impacts all of this. So we're all small business operators for the most part.
It seems to me that the most successful companies in this space are the ones that do facilitate that buying back of metals when the client comes to you, because they understand that they might come back to you in the future and buy more off you again. So it's kind of like, but if these guys who are shuttering their doors when they maybe don't have to, just because things have run a little hot, I guess I understand it to a certain degree, but it's kind of like, this is your business, you bought the ticket, you got to take the ride type thing. And at what point do you lose trust of people when you close your doors and you say, well, we're not buying anymore, but we'll sell you it? To me, that just doesn't sound right. And I understand there's a cash flow issue. One would presume that they've probably done well up until this point, but maybe nobody anticipated the run we're seeing. So, their inventories were a little light to start, but that's kind of my perspective on it. I would gravitate towards a company who had a very simplified process of, if I wanted to sell some metal, I could sell it back to them quickly. And I would be more inclined to buy from that company in the future if the easier they made that process, if that makes sense. Kind of like how, how Amazon and Walmart, they operate on very thin margins, but they do large volume. And so it seems like whoever can do that, kind of make it easy to sell metal as much as it is to buy it, I think they'll be doing quite well in the industry.
Right. And that's really what our model is. We're a small company, but we do big volume of business. And you said the word that matters the most, trust. If people trust your business model, how you treat each other, how you answer when there's volatility, they trust you, they'll do more business with you, whether it's buying or selling. And that's one thing that we've tried to engender with our clients since day one was reliability, integrity of what we say and what we do. If we lock in a price and the market goes higher, we're going to sell to you at that price. If you sell to us and the market goes lower, we expect you to deliver to us, or vice versa, right? It goes both ways, but we have to honor what we do first, because if we don't and we lose trust, then we lose everything. And we can't do that.
And you upload videos to the American Gold Exchange YouTube channel. How often do you do that?
Well, under normal market conditions, I would do a video about every 2 weeks. I like to tape on Friday afternoons after we've seen market action, because it takes a day or two to get the videos edited, put some graphics into them, make them a little bit more attractive to me just talking. So I like to tape on Friday afternoons and then release them on Monday mornings. Gives us the weekend where the markets are closed. Because markets can move so fast, by the time you tape a video, if it's not live on a Monday and you release it on Wednesday, you could look like an idiot.
Yeah,
right?
Exactly. I know that.
So we used to do written market updates about every month or 2 months, but when the market got real volatile following COVID, it's like now we all do Zoom and are used to doing this kind of stuff. I can tape and talk much more quickly and be responsive to the markets. So now I'm doing a video a week right now. But I tried to deliver an integrity-driven market message, facts, what's really happening, no hype. People that are intelligent and can see through the conspiracy theories, which were a lot of them in our marketplace, or some of the hype. We attract those kind of people who rely on a message that's fact-based, that's driven by real market events and not some of the other conjecture that happens.
And not artificially intelligent or unintelligent conjecture.
Well, if you're training on AI and you get garbage in, you're going to get some garbage out, and we've seen that already.
That's
right?
For sure. It's nice to see Asian guy lose his steam on the platform, but I have a feeling he'll be back in another form.
Oh, well, he could be Hawaiian guy or, or European guy next. Who knows?
Yeah,
There's going to be more of that. There's more of that's coming. This is just the start.
Absolutely. All right, man. Well, I want to thank you for coming on today. I'll post a link to your YouTube channel in the description below. People want to go and check out what you have to say over there. It's been very enlightening, and thanks for sharing your perspective on the industry. And I guess if people have more questions about the service you offer, they can go to American Gold Exchange, or is it Amerigold.com? AMERGOLD
is the website. Email info@amergold.com. And YouTube channel's American Gold Exchange. Pretty easy to find. So thank you, Nate, for having me. I appreciate you're inviting me on. And if you'd like to have me back in the future, I'd be more than happy to speak with you. I like what you're doing. And, we love Canada.
Absolutely. Well, who knows? The way things are going, we might be the same country soon if Trump has his way. But some people like that up here. Some people don't. I guess we'll see where the chips fall. But thanks again for coming on. Appreciate it.
Thank you, Nate.
You take care.
The best way to support this channel is to support yourself by gearing up at CanadianPreparedness.com, where you'll find high-quality survival gear at the best prices, no junk, and no gimmicks. Use discount code PREPPINGGEAR for 10% off. Don't forget, the strong survive, but the prepared thrive. Stay safe.